Hello, in this video, we will be discussing an overview and some basic information about accounting. I hope you would enjoy watching this video and learn some fundamentals about the topic. Please click on the subscribe button below for updates on new videos from this channel. What is accounting? There are two definitions presented in this video. The first one is from the American Institute of Certified Public Accountants, which states that accounting is the art of recording, classifying, summarizing in a significant manner and in terms of money, transaction, and events which are in part at least of a financial character and interpreting the results thereof. And another is from the American Accounting Association, which states that accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. From that definition, we gather that there are three basic components in accounting. First is recording, where all transactions that is happening within the business or organization is being recorded. The accountant keeps this record in an accounting book, as we call it. Nowadays, because of advancement in technology, we have all these different types of accounting software that we can use to help us in our record keeping. The next is classifying. Here, the data that we gather and record are being classified and or categorized in a meaningful set of data that can be used by business decision making. Common groups of classification of data are assets, liabilities, revenues, expenses, and so on. We will have further discussion about this later. And lastly, the summarizing and reporting part. This is when the financial statements come into form. The information which we gather from the recording and classifying stage are now summarized into a report which the management can use to base their decision making on how to steer the business and move forward for its growth. What is the difference between bookkeeping and accounting? You might be wondering what is the difference between the two. Bookkeeping is the part of the accounting process where the collection, classification, organization, and recording of financial transactions happen, while accounting is the second part of the process where the summarization and interpretation of the financial transactions recorded is done. There are two methods used in accounting: the cash basis accounting and the accrual basis accounting. Now let's briefly go through the description of each method. Cash basis accounting is a method where transactions are recorded when cash is received and paid. Cash should be present for a transaction to be recorded. While in accrual basis accounting, revenues are recorded when earned and expenses are recorded when consumed. Receiving or paying cash is not basis of recording the in accrual basis. These two methods over time has the same result. The main difference would be on the timing of recording the transaction. The timing difference occurs between the two methods because revenue recognition can be delayed under the cash basis until the customer payment is received, and the recognition of expense can be delayed until the supplier invoice has been paid. Let's look at some examples to better get a good idea between these two methods. Example transaction in recognizing revenue. Let's say a company sells $5,000 worth of clothes to a customer in January, and this customer pays the invoice in February. Under the cash basis, the seller would only recognize the sale in February when the cash has been received, whereas under the accrual basis, the sale is recognized the moment the sales invoice has been issued in the month of January. Example transaction in recognizing expense. In this example, a company incurs a $100 utility bill in March, which it pays in April. Under the cash basis, the company would recognize the expense in April, because that is the time when the bill has been paid. Whereas under the accrual basis, the company would recognize the expense in the month of March when it incurs the expense. Cash basis is widely used by many small businesses because they have simpler transactions. Big companies use accrual basis because of the complexity of their transactions. Next is the chart of accounts. A chart of account is a listing of account names that a company would be using for recording their transactions. Maybe some of you are already familiar with this, or maybe this is your first time to encounter them. Now let's have a look at how these account names are being organized in the chart of accounts. Typically, accounts are listed in the following order. First are the balance sheet accounts or the real accounts. Balance sheet or real accounts are those accounts that retains and rolls forward its ending balance to the next fiscal year. These accounts are assets, liabilities, and owners or stockholders' equity. Next are the income statement accounts or the nominal accounts. Income statements or nominal accounts are those which balances of one fiscal year are transferred to real accounts. By transferring the balances at the end of the fiscal year, the nominal accounts resets to zero balance and starts off the new fiscal year with zero beginning amount. Some of the accounts under the income statement are operating revenues, operating expenses, non-operating revenues, non-operating expenses. Let us go briefly as to what accounts are commonly included in a chart of accounts. Here we can see the asset account heading, and under this group, the following are the most common accounts that can be used. These accounts can be made as another group heading, and under them specific subledgers can be made. In a small company's chart of accounts, we might find under the asset section the following: cash, accounts receivable, merchandise inventory, prepaid insurance, land, building, accumulated depreciation for building, office furniture and fixture, accumulated depreciation for office furniture and fixture, office equipment, accumulated depreciation for office equipment, vehicles, and accumulated depreciation for vehicles. Under the liabilities section are the accounts loan payable, accounts payable, wages payable, interest payable, unearned revenue, and accrued expenses. For owner's equity section, we can find the capital and drawing account of the partners. The other account categories such as operating revenue accounts, operating expense accounts, and non-operating revenues, expenses, gains, losses are accounts that can be found in the income statement. Now we will discuss briefly the three major financial reports that an accountant generates to sum up the financial transactions of a business. The three financial reports are income statement, balance sheet, and statement of cash flows. The financial that shows how profitable a business is over a given period of time is the income statement. This report contains revenue, which comes from the sale of goods or fees for rendering services, expenses incurred by the business in the process of producing the goods and or rendering services to the customer. Next is the balance sheet. Account categories under the balance sheet includes the assets, liabilities, and owner's equity. Assets includes cash and cash equivalents, accounts receivable owed by the customers to the company for the sale of goods or services. Inventory is also considered as asset. In short, assets are the resources owned by a company which have a future economic value and can be expressed in monetary terms. Liabilities are the obligations of the company. Amounts owed to lenders and suppliers can include amounts received in advance for future services to be performed or future sale of goods. Owner's equity is the owner's claim to the company assets after all of the liabilities has been paid off. As you can see, the main accounting equation for this financial statement is assets is equals liabilities plus owner's equity. The third one is the statement of cash flows. The third financial statement is the statement of cash flows. This statement shows how the cash amount changed during the time interval shown in the heading of the statement. The management can see at a glance the cash generated and used by the company through operating activities, investing activities, and financing activities. The information of this financial statement will come from the balance sheet and income statement. So that sums up our brief introduction to accounting. I hope you enjoyed this video. Please don't forget to subscribe or to get an update for new videos to come. Enjoy learning.